Rene, thank you so much for being here. I really appreciate it. Um, I'm excited because we have a lot of people asking us about like what's going on with commercial lending and the commercial lending world. And so since we have that question, I wanted to come to an expert in the field as well. And so can we just start off and have you tell us who you are, what you do, who you're with, and
Sure. No, I appreciate the invitation to kind of just partake in this and kind of give you a one lender's point of view. But I'm Rene Flores. I work with Amplify Credit Union here in the area. And my job is strictly kind of focused on commercial lending. So everything I do is either investment or owner occupied type of lending, but that's really all I touch. And the cool thing about my job is that we work with a lot of different people and different scenarios, and quite honestly, what I like about Amplify is that we can actually lend anywhere in Texas. So if the property is somewhere in Texas, we can figure it out. And that also means that, the buyers, the borrowers don't necessarily have to be in Texas. I mean, they can be other states, other parts of we have done some in other countries from time to time, but typically they're other areas and they're coming here. So it's not just local buyers that we help. It's certainly anybody else that wants to buy in the state of Texas. And Texas is certainly right now a place where a lot of people want to be.
that's for sure, yes. Okay, well, so kind of fill us in. So what's going on in the commercial lending world with everything kind of going on right now? What are you seeing?
Yeah, so it is a hot market as it is on the residential side. I mean, when I say that there's people coming here, it is a very true statement in the sense of it's not just guys or people in Round Rock and not just people in Central Texas. It's people all over the state of Texas. It's in other states as well. And they're all coming here. And I still think that, sometimes locally we may think that the market is high or expensive. But as a point of reference, I mean, coming from other markets or the East Coast, West Coast, I think people come here and they think, wow, that's all I'm paying. It's on sale and I still have money left over. And, they may take two of them, give me three of them. But I think there's just a desire to be here. And certainly with the last couple of years, I think people realize they can live and work and anywhere in the country, and they're picking places that they desire to be at.
Well, and I know things change probably by the minute almost, but in general, and I know it depends on the product you get or whatever, but what are you seeing in the interest rates right now on the commercial side, and how are approvals looking? What does that look like?
Yeah, so rates probably across financial institutions, and I can't speak for everybody, but you're probably looking best case, mid to high fives right now for commercial rates. Something just to mention, rates on the commercial side typically are always going to be a little bit higher than residential rates, but even residential rates have gone up significantly. I mean, I think they're sixes, if not very high fives, or very low, mid sixes for residential stuff. So commercial, right now may actually, be about the same. And so when I say that's in that range, I mean, that's probably best case scenario. And that's probably going to be scenarios where it's owner occupied and or investment properties that you're looking at. If you get into a construction deal, which there's still plenty of people doing construction, that may be a little bit more expensive on the front side, meaning maybe a point higher, because any type of construction loan, most of the risk is during the construction period, right? When you just have land and boards and shingles and everything, and until it's all put together, you don't really have a finished product. And that's always kind of where the most uncertainty lies is during the construction phase. So that'll be priced accordingly. At the end of the day, anything commercial is really priced according to the risk, right? If it's a pretty straightforward deal, the risk is a little bit higher, lower. If it's got some construction, if it has some draws involved with it, some capital improvements, then that's where the rate may be adjusted. And then certainly, a lot of that is determined by how strong the credit looks as well, and how strong the borrower looks, and that will determine some of those little nuances in the rate and how that gets decided.
Okay. And so if I heard that right, when the approval side of things, that's pretty straightforward. You just got to go through their side and then the project side, right? And it can be a pretty quick process, or
Yeah, I mean, so a lot of what Amplify does is we do a lot. We find ourselves doing a lot of investment properties. So I mean, these are not owner occupied. We love owner occupied properties. The things that we're focusing on is kind of the if it's so hopefully best case it has a tenant in the property and it already has a lease on it. And then secondly, you're looking to make sure that the property itself cash flows, right? And so the rents that you get, less the taxes and insurance and maybe some maintenance, that what's left over is sufficient to cover the debt obligation that's created by borrowing on that property. So you always want to make, in the best case world, you want to make sure that the subject property being acquired is going to stand on its own, right? As an investor, you're going to be smart enough, hopefully, to kind of look at that and say, you don't necessarily want to have to feed that out of your personal funds to make that work. You want it to kind of make sure that it stands on its own, and that really is a function of how much rent you're getting on it on a monthly basis, and then the other variable on that is just going to be how much you're borrowing against property. So you may have to put not 20% down, you may have to put 30% down to make sure it cash flows. And so we kind of try to guide our borrowers on that, and certainly we want to make sure that every borrower that we help is going to be set up for success and not challenges down the road.
Okay, that's really good. On the owner occupant side, I know you said you do that too, because we have a lot of people come to us and a lot of our friends and clients, and they'll look up and say, we're signing all these long-term leases. Like, is there a benefit in buying, and what does that look like? I don't know what your take is on that, but.
Yeah, I mean, certainly there's I believe there to be a benefit in buying, especially, two things, right? I mean, with the real estate market being as hot as it is, I mean, I don't think it's a bad thing to buy property, right? And so Central Texas as a whole, if you listen to any local economist or as they're kind of trying to read the tea leaves, I mean, they're going to say that Central Texas market is, and it's expected to remain, a pretty sought after area, right? And so, it just, again, trying to look into the future, but, assuming that that's correct, prices are only going to escalate. So, I mean, if you don't bite the bullet now, if you have the ability to do it and you can bite the bullet, then you have to really kind of think of it in the sense that you're just replacing your rents for a mortgage, right? And so a lot of the times that may be a wash or maybe even improve the situation. And then on the other hand, if you're able to secure the property and you buy it for yourself, you just have to realize as well and plan and discipline yourself to put money away for maintenance and put money away for taxes and put money away for other items that maybe as a renter you weren't having to deal with. But certainly if anybody that's considering that, certainly would want to advise with their circle of advisors, certainly your accountant or CPA, your attorney, because we have a lot of investors that will buy under LLCs for the protections that it offers to them. And again, talk to your attorney. And then secondly, they may have talk to your CPA, because there's certainly some tax advantage that you'll get as a property owner that you may not get as a renter. So there's all those expenses that perhaps are able to be come off of your or apply towards your income tax situation when you're filing your taxes. So there's things that, again, talking to the proper advisors in those world. I'm not an attorney, I'm not an accountant, but certainly you want to visit with them and ask them their opinion, and so that you're making a good informed decision.
I agree. And we've had a handful ourselves on our side, friends coming in and looking at what they want to do. They're business owners. And again, I never do blanket statements. It's not for everybody, but all of the ones we spoke to, I mean, it was very smart because they could fix their expenses for the most part. They couldn't fix, property taxes and insurance and all that, but they knew what their rent would be if they bought. So they thought it was very secure. The other thing that they really liked about it is eventually that building's paid off. Eventually they're going to retire. So now, depending on how they're going to close down their business or sell their business, they also have an asset to go with it that they can either lease back out and already have an automated tenant, or that they can sell and have even more value in the business. And so when they run those numbers, it's a pretty big, and versus what they paid in rent all that time to get there.
Yes.
Our clients love it. So it makes good sense.
Yeah, no, I agree. And then, you'll have some buyers that may find a facility or a building that has, for example, 3 units, and they know they need one of them, and then they are renting out the other two for other sources of income. And then to your point, then maybe they have other two tenants helping them knock that down. And then at the end of the day, possibly in the future, if they decide to, they could perhaps have 3 units that are all paid for. And then even if the business goes away, I've seen a lot of business owners that will retain the real estate and just use it as rental income. And mailbox money is not a bad thing sometimes.
That's right. Okay, so that you talked about non-owner occupied and owner occupied there. So some of our newer business owners coming in and buying for the first or second time, they don't even know what kind of loan products are out there. So and I know you probably have a whole bunch of tools in the tool belt, but can you just give us some, like, hey, there's these types of loans and terms and what it could look like so people can get an idea?
Yeah, so certainly do that. And just kind of go back to the owner occupied type of loans. There are a lot of institutions that they want those owner occupied loans. And so the rates are very attractive. And sometimes, and again, I always tell each borrower, do your homework, right? I mean, talk to several institutions, but a lot of institutions will do a 5 or 10-year fixed rate on an owner occupied building, right? And so there's certainly advantages to, again, it behooves anybody to do their homework, to go find out what's out there, right? I mean, I'm not necessarily going to tell you to go talk to, 10 other banks, because, I want your business as well, but, it certainly makes sense for you to go do your homework. Because again, owner occupied, sometimes you can, and again, this may change in the next month, but it has historically been that you could find 5, 10, maybe even 15-year fixed rates. And so to your point about planning for expenses, that's certainly something that a lot of buyers will find themselves doing.
Real quick, I just think that's important to know. If someone is a first time commercial buyer, that what's really different is you would think in the residential world, of course, you're getting normally a 30-year fix. That's what it is, and everything's there.
Right.
That's not normal in the commercial world. In the commercial world, you might get a 25-year amortization, but it's all due in 3 years or whatever that is. It's a balloon note. So explain that too a little bit before you go into the next product.
Yeah, fair point. The bulk of commercial loans are going to be two things. The amortization period is typically going to be shorter. You'll have some lenders that do only go up to 20 years on amortization. You'll have some that do 25. Amplify does 25. You'll have some lenders, and Amplify included, maybe on new construction, will actually go out 30 years on the amortization. And the reason that's important is because that certainly impacts cash flow when you're looking at your numbers, right? When you're looking about how much rent you're getting versus your coverage, the debt obligations that you're making. So 20, 25, 30, that makes a difference when you're running numbers on what you can do and what you can't do, right? And so also another important thing is again, not blanket statements, but in general, commercial loans, the rates will be fixed for anywhere from 3 years to 5 years. That's typically what you see. You'll see some that do a year at a time. But I'd say the bulk of them are 3 years or 5 years, meaning that rate's going to stay good for 5 years. And then there's going to be a predefined adjustment period. It may adjust at the end of 5 years to Wall Street prime plus a half point, Wall Street prime plus 3/4 of a point. And so all that does is it kind of lets you know as a borrower that you at least kind of know worst case, right? You know that in 5 years, if interest rate was 8%, prime was 8% for whatever reason, and you have an index of prime plus a half point, then you know that your rate would be 8.5% for that next period, right? And so you can at least kind of plan. And at the same time, you can kind of say, well, the market rates in general are cheaper than 8.5% in 5 years, and so maybe it's time to refinance the property, to some cheaper type of money. So commercial loans, typically they're going to be variable. And again, that rate will be good for 3 years at a time or 5 years at a time. And then at least at Amplify, we don't hold our maturity is always going to be, at the most, it's going to be 15 years on On a lot of investment properties, multifamily complexes, we may just go up to 10 years. So every lender is different. So, you just have to do your checking on that too. But so what that would mean is, on a multifamily complex at Amplify, maybe it's a 10-year balloon note. It's a 25-year amortization. And then that rate would be good for 5 years at a time, and then adjust at month 61, I guess, for the second half of the loan. And that's what that looks like. Other things to consider in a commercial loan request are going to be, some lenders will build in a prepay penalty, meaning that if you were to prepay that loan off within the first, Amplify is 3 years. So if you pay it off in the first 3 year, year one, you pay 3% of the balance. Year two, 2% of the balance. Year three, 1% of the balance. Now we get most of that on every loan that we do. And if for some reason the borrower says, I don't want to prepay, we can get there, but the rate's going to be a little bit higher to make that accommodation. So there's a lot of levers and some flexibility as how you structure it. But we're always going to structure a good deal for both us and the borrower.
Well, and you talked us through everything in terms of, the approval process and what that looks like and the kind of different loans and what else is out there. What else am I not asking?
Yeah, so I think probably it's always, I always give advice to people I'm talking to is make sure you have good record keeping. There's so much to be said for presenting everything in a kept fashion, right? And make sure if you're a business owner, I certainly would advise and counsel you to, hire a bookkeeper, right? Hire an accountant, have somebody do your quarterly financials or yearly P&L and balance statement, because that helps a lender have more confidence in your numbers, right? If you're bringing me a box of receipts and you're saying, hey, I think it's in there, I'm not really sure what it was, my spouse takes care of that. And, unfortunately, a lot of spouses just don't have the capability to keep books, but they do it because one of the spouses is really good at their craft and the other one's, get stuck with the bookkeeping, and that may not necessarily be their forte. So, hire professionals to help you out, because what happens when you bring me a box of receipts with stuff and everything interchanged, I have less confidence as a lender. I have less confidence that you're actually giving me good information. But if you're giving me well kept and thought out books and records and financials, and like say, if I need tax returns, exactly where they're at, and exactly what they're kind of, have in them, I have more confidence in working with you, to get to an end point. But certainly I would advise, record keeping is important, not just for you specifically, but any lender you come to certainly will feel a little bit better about what they're seeing, and again, confidence. I think unfortunately, when you have to go ask 10 times for something, it makes you think, well, I remember really dealing with somebody, you always want to make sure that the loan is going to be a good loan. Certainly nobody makes a loan with the thought of it going bad, or with the thought of you're going to have to chase it because the borrower is going to you'll never see them again. It makes sense on everybody to do their homework and do their checking out to make sure that there's a good request there, and any lender just wants to make sure that ultimately that they have the capacity to repay that loan, right? And that's what you're looking for when you're lending money. It's easy to lend money. It's you want to make sure that you lend it to the right people and you're going to get paid back, because nobody wants to take a property back. Nobody wants to go chasing somebody for loan payments.
I agree. I totally agree. No, well, I appreciate you, Rene. Thank you so much. And this was very helpful. And,
yeah,
if we have anyone that has questions, that we can send them over and do all that. But thank you so much for taking the time with us.
No, you're welcome. It's my pleasure, and certainly enjoy working with you and your firm there and all your agents, because y'all do a good job in the community. And I think you represent the profession well. So thank you very much.
Thank you. I appreciate you.
All right. Thanks, Robert.
All right. Bye-bye.